What's up, everyone? Welcome to the Options Trench. It is Kris and I. Today, we want to talk a little bit about what's going on in the world currently. It's 6 March, and there's a lot of stuff going on that has kind of caught our eyes, specifically talking about the US, Israel, and Iran conflict. So, like a really, really quick synopsis, there's a ton of news out there about this, so I'm not looking to get, super deep into detail, but just to level set, a lot of times, at least the way that I look at markets, Kris, is like when there are big things like this, I tend to see a lot of opportunity arise because the market then seems to be massively trying to price things. And not everybody can agree. We could even see that recently with the moves in oil. It's been kind of all over the place. So, I guess to start off really quick, I'd like to hear your thoughts on the way that you think about news catalysts like this and the way that you use things like this to trade and make investment slash trading decisions, whichever is more common for you.
Yeah, I mean, really, the first place I start is by trying to observe what's happened. Like, as far as like, what's actually going on is the first thing, and that's all guided by prices. And then we want to take prices in the right context. So, some of the things that I noted this week was implied correlations actually started to pick up this week a little bit. We got over 20% implied cores in the 3 month S&P. And then the other thing I'm noticing is like if we look at the various sectors, we can one thing I like to do is look at everything in terms of like how many standard deviations have we moved. Just obviously 5% means something totally different in you know Palantir versus the S&P, right? So want to put everything in terms of standard deviations. So if I'm looking at the market right now, fixed income, like looking at things like IEF, like 10-year and TLT, the long bond, like those are down uh, about almost two standard deviations since last Friday. The dollar is up over one standard deviation. Most equity benchmarks are down more than one standard deviation. Um, and then, of course, the big story is oil. Oil is up more than two standard deviations. And I want to be clear about when I say standard deviation, I am basing this off of what the implied volatility, the near-term implied volatilities are already. So oil was already pricing in a lot of volatility in the market, and that two standard deviations is based upon that already fat implied vol. So all of these numbers are net of what was already sort of priced in. So this is really significant moves. So the basically you're getting a flight to a dollar, you're starting to see a tick up in correlation. You're seeing the equity benchmarks fall off. Um, and then of course oil kind of leading the charge here. So like that's like the main thing is like what the heck is happening? Uh as far as for trading, it's kind of like so the first thing I do is I like to look at what's happening in vol surfaces and seeing what's changing. And the big story in oil is that the skew is completely going nuclear to the calls. I mean, it's repriced so quickly and it's super extreme. This is like one of the most extreme skews I've ever seen in oil, meaning that the calls are extremely expensive compared to the at the monies, and the puts have gotten wrecked relative to the at the monies, and the vol is super steep. So we can get into it, but that's leading to some very interesting pricing. And we were talking about this off camera, but off the mic, but the what's going on poly market, and I can talk about that a little bit too. But for the most part, it's exactly what you said. Like as everything starts going, as all the prices and volatility start to pick up, you get things that didn't move together that start moving together. That's the whole idea of like correlations. So you're really just trying to like sift through things and be like, what option surfaces are moving up, where calls going up, where puts going down, like all that kind of stuff. And this is all like in vol space, like relative to each other. That's where I look. I want to see what looks abnormal compared to the main liquid names.
And that search for deviation is kind of the bedrock, I think, for what a lot of us do in general. And I think with moves like this, there's a lot of changes that we kind of know are going to happen in like the vol surface, VIX complex, that side of the world. Then we know that there's typically other structural changes in terms of ETF inflows and outflows. A lot of times you'll see, different kinds of flows into defense spending, defensive style names, staples, stuff like that. We know with Iran, there's a big energy risk, not stemming from the immense dealings that we, the United States, have with Iran, obviously, which is about zero, but because of indirectly through something like the Strait of Hormuz, which fascinatingly, from a tactical perspective, it's one of the coolest things to see the way that Iran has tried to play to their strengths, what they have, which is using a lot of volume. That's why they had these massive stockpiles of different ICBMs, intercontinental ballistic missiles, fast moving ships and whatnot, which are just the way that countries like that interact with one another has always been really, really fascinating to me. But all of that bubbles up to a lot of opportunities. And I want to start with an observation because I remember, Kris, you talked about this in one of your posts, but it's a really common question, which is right now in USO, if I go out to 17 April, which is 42 days, and I look at the money calls right now, that would be like the 109, 110, something like that. Those are right now at like a 58, 57 delta respectively. You don't actually get to the 50 delta option until you're essentially between 115 and 120, probably like the 117 or something like that. There's just not single dollar strikes there. A lot of times from a more lay perspective, people would expect to see a 50 delta being closer to at the money versus pushed super far out of the money, relative at least, like this. So talk a little bit about that. Why does that happen?
Yeah, the main reason that happens is because option models assume that the stock can't go below zero, which is correct. I mean, USO cannot go below zero. So uh, what ends up happening is like if you think about it, like if you raise the volatility and you say that, well, this thing is bounded on the left side, it can't go below zero, then all of that volatility has to extend the right tail. The right tail has to get further, right? So what ends up happening is the hedge ratio, which is all delta is the hedge ratio, says that in order for me to hedge, because this asset can now go up 100 vol means that the asset, in theory, if it was a 100 vol for a year, it's not for a full year right now, but like let's say it was for a year, that means that this asset could double in price. So if you think about it, if you sold a call option and you needed to buy some amount of shares against it to hedge it, and there's a lot of volatility to the upside, what it's basically saying is, well, instead of needing 50 shares to hedge selling one at the money call option, I really need to buy 57 shares to hedge that call option because it can go so far to the right that I need more shares to compensate me for the case where it does go where the stock skyrockets. So basically, as you raise volatility, it's like you're raising all the area under this curve, but the curve is cut off at the left. So that volatility has to get smushed a little bit more to the right, and that's going to raise the hedge ratios on your calls. What's interesting about that also is, remember, if we raise that call to 57 delta, we're lower that at the money put is dropped to a 43 delta. So if you wanted to bet on the market dropping, you're going to end up, and you want to have a high delta bet of it dropping, you might have to go buy it in the money put. Like you're not even getting a full 50 deltas from buying the at the money put. And those out of the money puts, if the at the money put is 43, the out of the money puts have even lower deltas. So you might not be getting nearly as much if you're trying to bet on it going down. You're not getting as much delta exposure as you normally would when the vol is lower. So just really, really important just for understanding that when you look at your software, you're not crazy when you see that the at the money is 57 delta. It's not broken. That's correct. But also, if you want to make sure that you do look at those numbers when you decide what delta you want to have on your trade.
And let's double click a little bit further. And for context to what Kris was just talking about, like I said, USO right now is at 108.77. This is in after hours. That's just where it closed. And the 115 put, so, $6+ in the money is a 47 delta. So it's exactly what you were just talking about. You have to go pretty deep in the money to even find a 50 delta. But to zoom out just a little bit, and then to talk about the tactical implications of this. So let's say that you open up the platform and you were just looking at USO for whatever reason. And let's say that you see that the at the money deltas are like a 57 delta, and then on the call side, like a 57 delta, and then the at the money put is a 43 delta put. Like, what are the immediate implications of that information in the way that you bake that into whatever the ultimate analysis is? So what are the specific data points you would pull from that?
Well, for me, it's just a measure. For me, it's just measure. I just think about it as a measure of risk. It's really just it's just telling you that this is how that option will respond to the movement in the underlier. It is it's it's a pretty mechanical thing. It's just like if you raise the vol, that is basically what's going to happen to your deltas. I think the thing that's the wrinkle that makes it a little trickier is that uh, because we know that as USO goes up, the vol is going to increase as well. We saw this. This also happened in silver in Q4 of last year and January. If you have an asset which has an incredibly strong reaction function to the underlying going up, and then that vol, meaning the vol responding very quickly to it and in a strong way. What's going to happen is that means that the deltas are even higher than you think. So, for example, your out of the money call delta, uh, if I know that, let's say I buy like a 20 delta call. Okay. The model says it's 20 delta, but if I already know that if the stock goes up, that the vol on that strike is also going to go up, it's going to pick up more deltas based upon the vol going up. Like let's we're talking about the 135 strike. Let's say the 135 strike has a 20 delta. Well, if the stock is 110 and it goes to 115, the vol on that strike will probably go up as well as the whole surface kind of goes up. So that strike is not only higher delta because of the gamma, because we've just went up $5, but also because as we increase the vol, all out of the money options become closer to 50 delta, right? So like that out of the money call that is 24 delta, that now it went from 20 delta, maybe it goes to 24 delta due to gamma, and then you raise the vol, and then that maybe pushes it up to 28 delta. So your deltas are bigger than you think on those out of the money options because the vol and the direction are working in the same, they're working together. So what ends up happening is if you buy those calls, if you do want a specific delta, you could potentially buy less of them than you think you need. Likewise, if you were trading this and you were short those calls and you hedged and you wanted to be delta neutral, you probably need to over hedge and buy more shares against being short them because your actual delta is probably shorter than you think if you're short those calls and you only hedge it on the model delta. So this is like uh, this can and this to be fair, like running delta neutral books is a lot more complicated than sort of just like trading options outright because those relationships can vary through time. Like if you asked me a year ago, I would have said like, well, if you buy this call and the market goes up, it's possible the vol actually falls. That's the normal oil typically acts like the S&P, where market up, vol falls. Right now, it's just inverted. So you can't you that's kind of the point is like when you log into these things and you look at the surface and be like, hey, the stock is up and the vol is up, you need to take note of that because that's telling you something about the regime that we're in. Because sometimes when the stock is up, the vol is down. And in an asset like oil, the skew flips. It can go positive and it can go negative. And S&P, it never flips. Like the call is never going to trade over the put in the S&P. So but something like oil, you want to pay attention and be like, well, what's happening with the vol and what's happening with the stock at the same time? And now I can understand where the market sees the risk. Does the market see the risk to the upside or the downside? Another great, by the way, example of this is Bitcoin, because like Bitcoin skew does whip around as well. So, I kind of noted it earlier this week on Twitter, but Bitcoin vol went up with Bitcoin going up, which is unusual. That has not been the case for months. So I thought, unfortunately, that kept me. I stayed long. I owned some Bitcoin calls, and normally I would have considered sort of like rolling them up, but I got more bullish because I thought it was bizarre that the vol went up as the stock went up, and
Oh
that turned
yeah.
out to be wrong.
Well, I'm glad that Bitcoin is fucking us both up because I still have a covered strangle in there. So I've just been just enjoying the pleasure, the distinct pleasure of this thing falling 50% in like 6 months. Every time I open the platform, it's just like, oh, a pleasant little gift. Just a nice little here's a
So
treat.
I'll point something out to you though. Like, so this is interesting. You might be feeling a little bummed about being short vol on that Bitcoin strangle, but the thing that's interesting is I'm looking at a whole table here of like vol changes for the week, and Bitcoin vols were pretty flat for the week. So if you think about it in relative terms, most asset vols were up this week.
Mhm.
I think this is like an important thing to point out that um, if anybody that was like short Bitcoin vol this week, even though the vol is unched and the stock move around a lot, it was actually a good trade because if you were running a vega neutral book or a relatively option neutral book, anything you would have been long against these is performing better.
Mhm.
So even though it's unchanged, or even if let's say the vol was even up 1 point and you were short the vol, you probably had a great week if you were running a relative value book because you would have been long options on all these other things that actually did go up and Bitcoin only went up 1 point. So just kind of like pointing out that your P&L on that one item might be like, hey, that's kind of a bummer. Like I'm short vol in this thing and like I didn't have a good week on that. But in a relative sense, you were short the right thing.
I'll tell my P&L that. That'll
That's
that'll comfort me tonight.
this is called Vol Trader Cope. Yeah, it's my favorite pastime.
Yeah, fair enough. Yeah, it's just also been so fascinating for me, especially something like Bitcoin. It's what I consider a core position. It's something that I'm fascinated in longer term. I've been trading it for a long time, so it's all kind of part of the party. But yeah, I'm just glad that it has the ability to simultaneously mess up multiple people. It's good. It's misery loves company. Now, I want to talk a little bit about some of the opportunities that we can at least look at. When I say opportunities, it's not inherent to any type of approach, not long, short, long vol, short vol. It's just things that can be done that start to look interesting. And so, for context, with the conflict in Iran right now, as we know, it's really, really heavily air power based. And most of what the US is doing by far is intelligence, but then also a lot of offensive and defensive missile systems. So these are things like PAC-3 interceptors, the THAADs, F-35s, and their loadouts. There's a lot of munitions going off, both offensive and defensive. And one of the interesting things with the fact that the conflict hasn't ended already is the fact that as that continues, we know that there's going to be a demand for production. So if you were to think about defense contractors in general, it doesn't have to be, siloed too far to, asset producing versus intelligence or whatever else is interesting to you. But if you just think about defense sector and defense contractors and some of the opportunities that you might expect to see in the current environment, what jumps out at you?
Let me see. Let me take note of what's going on in some of these contractors. I don't know, pick one. I have a few up here.
I would say Lockheed Martin is a good one to start with. They're fun.
Okay. Let me take a look at so I've got a dashboard here of a bunch of a number of macro assets, and then I threw in a bunch of energy companies and I threw in defense companies. So let me take a look at LMT. I just got to find it on here first. Okay. So interesting. LMT is its vol change on the week here is sort of middle. It's a little bit higher in the middle of the range on the vol change. So its strike vols are up this week. So let me take a look at it here. You have a situation in LMT where, so first of all, this part's kind of interesting. It does look like the term structure actually steepened a little bit, meaning that the back month vols went up a little bit more than the front month vols. That in itself is kind of interesting because that's, we were seeing, you tend to see more inversions right now in vol term structures where the fronts are accelerating past the backs in a lot of names. LMT, it actually looks to me like the backs perform well. Part of the reason why is because the vol term structure is already inverted, it looks like. Um, so it's just a little bit of the back catching up this week. But I'm taking a look here. So what I basically will do is go look and see what's the vol doing, how does it look compared to the realized, what's the skew doing. The skew doesn't. So first of all, LMT skew doesn't really look like it's doing anything interesting in the 30-day options. The term structure is overall descending. It's not if you go from the 30-day to the 90-day, it's not descending much. I mean, the 30-day is 36.5%, and your 90-day is 34%. It's not a big dissension. The vols are pretty middle of the road. It doesn't have a giant risk premium in it. It has a risk premium in it. Like the VRP right now is about 15% over the 30-day IV is about 15% over the realized vol. So overall, it looks pretty fair to compare to how it's moving, even though the vols are elevated. But remember, the vols are sort of elevated everywhere. So if I had a really strong view about LMT, the vols are not crazy from the buy side. They're definitely elevated, but if you think that LMT is extremely levered to whatever's going on, and you're the whole, I don't really follow single stocks particularly closely, so I have no idea how LMT should really react to something by other than just saying oh, I would expect that LMT would, like a defense contractor, this should be a good environment for them. But that's from a 5,000-foot view. I'm actually looking at what it did today with this. It's actually down 2% this week. So, maybe that's not even a great thing to say.
A fun fact here for Lockheed Martin on 27 Feb at 11:30 a.m. Pacific, the net call premiums was 17.9 million. Half hour later, net call premiums were at 270 million.
Oh, that's interesting. So the call, and you know what? But it doesn't. Does it say what term that's in?
Yeah, it's split across a couple different terms. It was heavy on 20 March, And for underlying price
Mm.
over the time frame, underlying price went from 656 to 658, and then the next day it peaked out at 681. So one of my favorite things
Oh, it's
with
pretty nasty.
options, for those that don't know, is it is a little bit of wizardry, and I don't want to like oversell it. Like people will use terms like unusual options activity as like some sort of, magical playbook of answers and money. But what I will say is that there's a lot of fascinating artifacts that you can come across by analyzing options chains. That move, for context, in Lockheed Martin, the largest net call premium over the entire last 14 trading days, other than that move, was 1.9 million. And it went up to 188. It actually peaked out at 291. So people were piling into that move. That was actually a really effective, very short-term trade for a few different systems that I ran. And the other interesting thing was the relationship between Lockheed Martin and then some of the other names in that same window. So what we saw on the 27th of Feb did not happen in Raytheon, which I thought was really interesting. Same thing with Boeing. In Boeing, it went the opposite direction, which is also fascinating. So Raytheon was, well, at least a bunch of these different names have been behaving very, very differently. And I think a lot of that also has to do with what their current role is and at least the duration. Trump recently came out. What was this? This was on the 6th of March at 3:04 a.m. Pacific time, updated 32 minutes ago. This is from Reuters. And there's a meeting that Trump, I'll read some of it really quick. It says U.S. President Trump met executive from 7 defense contractors Friday, announced in a post on social media. The Pentagon works to replenish supplies drawn down by U.S. strikes on Iran and other operations. So the companies that were included were Lockheed Martin, Raytheon, BAE, Base Systems, Boeing, Honeywell, L3, Northrop Grumman. Those were all there. So really interesting movements in a lot of these names, especially against to the price behavior that you're talking about from a vol lens. So when you're analyzing like the volatility profiles of these defensive names, is there a natural time window that's more appealing to you given the backdrop of the current catalyst? So what I mean specifically is, with the war in Iran going on and your perception of that, do you prefer shorter term vol ideas, midterm long ideas, or I'm sorry, midterm to long ideas, and you can define those periods as what you are? I'm just curious if there's a spot that you gravitate towards, because from a price lens, I gravitate near term.
Yeah, so I would for me, I would probably what I would look at here is um you have a whenever you have a dislocation or some there's the primary driver of what's going on right now is oil, right? So what you can do is like you look to oil as a North Star. It's your compass. You say like, okay, so where how do let's say I look at every a single name and I say, how does this vol look compared to oil? And I look at every term to term. So I say like, you know, what's the how much is this thing moving compared to oil? Like meaning like what's the ratio of the realized vols between the two right now? What's the ratio of the implied vols between the two right now? And then you can kind of do the same thing by saying, okay, what's the ratio of the implied vols of these things like 6 months out, like the two in 6 month implied vols for each one, and look at that ratio and kind of say like where does it's almost like what is that ratio? What do those ratios look like if you were to just draw it on a term structure, like a term structure ratio, and say like what, just kind of like is there anything that kind of stands out as far as what's weird? Because here it's it's almost like the term. I think the action here, by the way, is like the short term is probably more interesting just because the oil stress. is very much in the near term. And if you even look at the way the futures term structure has gotten very, very steep in oil, where the front month future is trading. Actually, I got this up right here. Like the front month future in oil is trading for about $91. If you go 1 year, let's go to March of next year, you're just under $67. You have a $23 premium between right now and 1 year in oil, which is, 25%, well, it's more than that. It's like 30% of the price of oil if you pick the back month. So the market, or at least the oil market, is sort of telling you in some regards, like it doesn't necessarily believe that this is going to last for a year, right? The back month, the 2027 futures are not responding nearly as quickly. I mean, you wouldn't expect them to respond exactly as quickly, but they seem to be probably underperforming any beta that one probably would have guessed between the two. As a matter of fact, where do you see the slope of this drop off? I mean, you're talking about the August future is only $75.
Yep.
So this feels really acute to the front month. So this kind of tells me that the dislocations, or what's interesting, is like probably in the nearer dated is where the action is, because that's what the oil market's telling me. And that oil market is the thing that's in charge right now. By the way, I was looking up LMT and Raytheon when you were talking about it here. I want to point out something kind of interesting. Both LMT and Raytheon have a vol in the mid 30s. But Raytheon is up 12% for the year. Lockheed is up 35% for the year. So if we take a 35% move, and so we'll call that a 35% move over 2 months. So if we annualize that as a volatility, so we say 35% times the square root of 6, because 12 months over 2 months. If we do here, let's and 0.35 times square root of 6. Okay, that's an 85 vol. That's an 85 vol annualized, right? Meanwhile, Raytheon moved 12% over 2 months. So, if I'm looking at both of these names, I really like, if both the names are the same vol, I really like Lockheed's vol a lot better as a long versus being short Raytheon vol, if that was kind of my intent, because Lockheed seems to have a lot of response to what's going on right now, and I'm getting its vol for the same vol as Raytheon. So again, this is me not knowing anything at all about like what the fundamentals are going on in these names and what the stories in these names are, but like purely from how much have we like realized volatility, how much have we moved, that LMT realized volatility feels like it's understating the situation by quite a bit, because it has trended so hard since the beginning of the year.
Which is funny because when I look at like a 20-day realized move percentile in LMT, it's like 57%. And then as I look at Raytheon, it's 80%.
Yeah, it's like their vols are really similar on the dailies. But at the
Yeah,
end of the day, it's like this one has moved 35% in 2 months and one has moved 12.
right,
So, right? So like it can be very, very deceiving to just look at the realized vol and not see the wider picture.
right. Definitely. And the other question, for at least your typical approach on stuff like this, the way that I generally look would be playing Delta primarily, and then I normally would have some sort of secondary exposure to vol. But if you were to play some sort of vol idea in either of the names that you like, what kind of ideas come to the forefront?
Yeah, it's kind of like basically, I mean, my bias generally is just like, hey, maybe probably buying what's lagging and selling where the main stress is. The trick is it's hard to sell where the main stress is on, like, for example, where's the single most stressed thing in the entire market right now? It's oil calls, right? But it's very, I am not inclined to go pick the big, pick the battle with the biggest guy in the schoolyard, because that's really what you're doing is if you go and you sell oil calls, like yes, it probably has the biggest risk premium in there, but it is a risk premium for which there is no other side. There is no hedge to that. The entire world needs them, right?
Yeah.
So, uh, and it's open-ended. The problem is you can't just go sell a call spread on it because the call spreads are actually all really cheap. So the reason for that is because if let's say my 120 call is 100 vol, if my 130 call is 130 vol. Let's just, I'm just making up numbers here. Like the 130 call, there's not much difference between the 120 call premium and the 130 call premium, which is another way of saying that the call spread's really cheap. So you can't go ahead and sell the out of the money call and then be like, I think I'm gonna buy the even more expensive vol call and think that I'm capturing some kind of volatility or risk premium here. You're actually selling a call spread at a pretty cheap price, even though you're like net short call premium, right? So it doesn't work. Like the market's too smart for that move. So, um,
One sec. On that
yeah.
on that same thread of that move, there's another move that we should talk about quickly in literally that same exact vein, which is the we just said that we think in general calls are going to be really expensive. That's where most of the risk premium is. The first order of operations for the trader would be like, okay, I'll sell a call, don't like the risk, I'll turn it into a vertical, and you just walk through some of the downsides to that. The other enterprising trader would say, let me buy puts.
Yeah, so it's okay. So my what I would do here if I want to sell oil, I actually did this yesterday. The If I want to sell some of that oil vol, I would sell it on the put side. So it's kind of the exact opposite
Idea,
instinct to
which
like what some yeah. So the reason is if I want to take advantage of selling the really high vol, I'll sell it on the put side. It's pretty unintuitive because the whole scary part of it, not well, it's just like this idea that we're probably going to go back down, right? It's the whole like oil is being priced like this because there's this big geopolitical risk premium in it, not because the fundamentals of the market necessarily are saying that, a couple of months ago, oil was like way lower price, right? So it's the market thinks that the price is going to go back down. We can see that the long end of the futures curve, the prices are much lower. So there's a real chance that oil prices drop a lot. So it sounds kind of crazy to be like, oh, I want to sell puts. But the thing is those puts are going to get hammered on the way down. Those vols are going to get slaughtered on the way down. So if you sell those puts, you are going to, the question is how fast is the market going to drop when it drops? So for example, here's where this does not work. We all knew vol was going to fall when silver went down. Well, if silver decides it's going to go down 30% in one day, you're going to get killed on your puts. Even though, and by the way, the vol did go down. You still get killed on your puts because the move was too large. So from a vol perspective, uh, it's just a reminder that when you sell an option, you're not selling this number called IV, which is like moves around on a chart. You're selling both the vol in terms of Vega, but you're also selling how big is the move going to be, and you can get wrecked because the move is really big, even if the vol comes in. That said, if we don't tank, 30% in one day in oil, which by the way, the vols right now in the front month are very similar to what the silver front month vols were. So if you don't think that oil is going to drop 30% in one day or whatever, and you think that if it goes back down, it does so in more of an orderly fashion, then you will be okay shorting those puts because the premium in those puts will decline faster than what the delta says they should be picking up in terms of like delta P&L. So That is, and the other way the way I actually expressed the trade yesterday is I bought a 1 by 2 put spread. So I bought one put and sold two lower strike puts. The reason I did it that way was only because uh, I wanted a way to do it somewhat delta neutral, or like close to delta neutral. I didn't want to take a big delta bet by just selling puts outright. By doing it that way, I was able to be more delta neutral without needing to sell puts and sell futures because I didn't want to have any hard deltas sort of like pointing downwards. Like I didn't want to be short a future, which I can, then in that case, it's really a different trade. Like I can get wrecked because if the market goes up 25% in a day, I'm going to get destroyed on my future. And all I did was collect my option premium. So I don't want to have any short futures in my book at all. So I buy the put and I sell extra puts, and now I'm just exposed to like basically how are we going to go down? Like yeah, I'm still going to get wrecked if we drop 30% in one day, but if we grind down, that position uh, should decay nice. Like it should work. So that's why I chose to do it as a ratio spread. It's not because I love buying the higher strike put. It's just that I need some way to have a short delta without being short a future.
Right. Yeah. I mean, it makes total sense. And the funny thing too about that kind of playbook is that's the same general approach that I would use in like the VIX complex. If I thought VIX was elevated, I generally would go to the short put side of the equation versus trying to play short calls or buying puts, especially. It's similar, literally, very, very similar idea. Also, in terms of like what you would actually realize out in terms of, you know, one other thing on this general topic that I wanted to talk about pretty quickly is across the energy side of this equation, how do you view the different energy industries that you could find yourself focusing on? So, different kinds of producers, shippers, the commodity itself. How do you view that universe?
Yeah, I mean this is like this is interesting. Like we were uh my friend Tina, who's active on Twitter, she's a specialist in oil trading. That's what she does day to day. And there was a discussion yesterday on Twitter that started about like people were saying, you know, well, what if the U.S. government releases barrels from the Strategic Petroleum Reserve, the SPR, that would put sort of a lid on oil prices. And I think that this is not high resolution enough. Like this gets to your point about like understanding the market more. And like Tina kind of responds to that thread with something along the lines of, well, that's not going to help the European refiners. Like they are bid like crazy for product, like, basically refined product. And WTI, deliverable in Cushing, released by the US government, does not help them when what they really need is, say, like Brent oil, or they don't need light sweet crude in Oklahoma. So it's like it's not solving for what the market actually needs. So this idea that you're going to release these barrels and it's going to make the market softer really depends on like, well, does that allow it for there to be an arbitrage? Like, who needs the oil? Where's the demand coming from? Is the demand actually for what the US has, or is the demand for a higher grade of oil? And I think that that's where like it gets into a lot of the specifics of what companies are sort of, which companies are pure plays, like, what companies are pure, like a refiner, which ones are more vertically integrated. You know, that's where it just becomes a lot of discernment. And it's not clear at all that releasing, and first of all, my impression was like if you release barrels from the SPR, not even thinking about the varying demands for oil geographically and for different grades, but like maybe that just has more impact on the futures curve. So it makes the front month, maybe that makes the front month go down, sure, relative to the second month. But what have you done if you release barrels from the reserve? I think our reserve is less than a month's worth of oil. Maybe what that does is it actually pushes the back months up because then the back months are like, well, you can interpret this bullish for oil as like, well, we have less reserves. We have less slack in the system if you go ahead and you release them. So maybe all it does is affect the futures time spread rather than affect the entire complex and push the whole complex lower. It probably just changes the time spread. So I think you have to be it's like easy to say, oh, more barrels means price lower, but oil is just so multi-dimensional. It's not one price. There's prices across all these time and all these geographies. And so that's where it gets you can know enough to hurt yourself kind of thing.
Yeah, I find a like generally similar thread because the way that I would trade the commodity outright also changes a lot compared to the way that I would trade the individual companies, and the type of risk that I'm looking for changes significantly. Because if I want to trade, and I did on Futures Open this last weekend, because that's when the news originally started. Was it this past weekend or the weekend before? It would have been this past weekend because the news started to break on like late Feb. So the like in that kind of scenario, I immediately go to spot futures just to trade the initial reaction and get rid of all of the other stuff that tends to come with derivatives, or at least as much of it, and get into something that's delta one. But the other thing now that we're starting to go through and finish up an earnings season, finding individual vol is actually pretty appetizing. So the last thing then that I think would be cool to think about is what are some of the things that we're looking at going forward? And what are some of the things that we think could lead to more opportunities going forward? So, for example, we could start with something like the price of oil. Do we think oil continues higher, or do we think oil stabilizes and starts to contract?
Well, I'll tell you the thing that I find interesting right now, I just have to say this because it's kind of neat. It's this poly market thing
Perfect.
because
Yeah.
so we've got uh okay, so when the skew does what it's doing in oil right now, which is really extreme. It's hard for me to emphasize just how extreme this is, where the calls are so the vols on the calls are so high and the vols on the puts relatively are so low. These giant differentials between the two, and you're getting very bizarre prices for vertical spreads. The thing about a vertical spread that's really neat is that they are super risk defined, right? Like if a vertical spread is $5 wide and you pay $2.50 for it, it's like the most you can lose is $2.50. The most you can make is $2.50. It's basically, in other words, it feels like a coin flip. So that's why we can say these vertical spreads are like binary bets. They allow you to just bet like the pure probability of the stock ending up in a certain location. What's really interesting right now is I was looking at so I came up here and I was like, you know what? I kind of want to. So first of all, I got short deltas in a bunch of things this week, and I didn't touch oil. And then the way that I was kind of like wanted to monetize the deltas in a weird way is to say, okay, now I want to like bet on oil going back down again as a way to it's like rather than buying the deltas back into things that I'm short, it's like I want to buy oil like buy oil puts kind of thing as a way to like quote close my like make money on the fact that if oil reverts back down, I think the amount that oil goes back down has a high there's like a higher beta to that than like the stuff that I'm short going back up, right? So I kind of want to
Mhm.
monetize it in this like weird way. Now, The problem is that the oil market just doesn't want to cooperate with me because when I look at I don't want to buy the outright puts for exactly the reasons we discussed earlier today because vol's going to get smashed on the way down. What I really want is a put spread. Problem is the market doesn't want to give me a put spread at a reasonable price. So if you look at the various put spreads, the put spread that's down oil could drop 15% and you will get paid even money on the put spread that's 15% strikes lower. Like think about that. Like in order for you to make even money on oil dropping, you have to buy a 15% out of the money put spread. Like that's how expensive the put spreads are. Like in a normal market, it would be like 50-50 about like whether the stock is going to finish uh higher or lower than where we are right now. But right now, it's like the market's saying there's a 60% chance that we finish lower than where we are. And if you want to bet on the market dropping 15%, we're only going to give you in rather than like giving you 3-to-1 odds in the normal market, we're only going to give you even money, which is another way of saying that bet is really expensive.
Mhm.
But so I'm poking around looking at this in various ways, and then I notice on Polymarket. So Polymarket has a contract that says oil to finish above $90 by March 31st. And what they mean by oil, they mean the active contract on March 31st. Okay. The active contract on March 31st in WTI is going to be the April contract. The April contract right now is trading for 80 or kind of went out. The April sorry, it's the May contract expires will be M1 on March 31st. I know it sounds weird, but that's what it is. That contract is trading 87.60. Okay. Now, so the poly market was bidding 60% chance of that contract being over $90 by March 31st. But we just explained that the probabilities are that we're going to be lower, not higher. The most likely case, that's what happens when you crush the put skew and raise the call skew, is it does the exact opposite of what it does. It makes all the call spreads cheap, which means the probability of going up gets cheap, and it makes all the put spreads expensive, which means that the probability of it going down is priced very, very high. Poly market is doing the exact opposite thing. It is bidding for the probability of us being above 60, I mean, above 90 at more than a coin flip. Like it's laying odds for you to do this. So I went and I looked at like where is the options that expire on the last day of the month on March 31st? Where are those vertical spreads priced? And sure enough, you can buy the 80, well, granted, the markets are really wide, but the mid market on it is you can buy the 87.5 90 call spread, which is a $2.50 wide call spread. Mid market is $1 on that call spread. So you can get paid 1.5 to 1 on oil basically expiring above $90. Meanwhile, poly market is literally the opposite, where the market's willing to lay 6-4, 3-2 on the market being above $90. I mean, these are completely inverted markets. So I think there's an interesting question there. Like, you know, do you if you want to trade this, you could try to arbitrage both sides and just trade both legs of it. You could also just say, well, the WTI options market is an efficient, liquid, intelligent market, and that's probably that's probably fair. And the poly market is probably just wrong, relatively. Now, so it's this choice of like, do I want to try to like complete the whole trade, or do I just want to do like quote unquote the good side, being the good side, basically like fading poly market. So but here it's interesting because I get to have, first of all, the other interesting thing about this is like, if you look at the delta of like the 87.5 90 call spread, like it's super small. Like because the delta of both options is really, really similar. They're both like probably close to 60 delta options. or maybe 57 delta options, right? But you could imagine just creating a little stat arb strategy, and granted, if you have like good execution and all that on the poly market contract, because I wasn't watching it all day, but I'd be willing to bet that that contract moves around a lot more than the delta of that call spread, which means that, the probability really isn't changing all that much because those calls have like the same delta. But the poly market odds probably change a whole lot. So the poly market odds are just like being whipped around by like trading activity probably. Meanwhile, like the true probability like isn't really changing by that much. You have to have a huge move for that probability to like really change. Like whether oil goes up or down $3 from here probably doesn't really change your assessment of like where it's going to be on March 31st because $3 in the context of how volatile it is just isn't very much. But poly market is like overreacting. That market might be overreacting to those a $3 move, thinking that a $3 move is a bigger delta than it really does. So I don't know. That to me is like kind of interesting where you have, one market that's like more mature versus another market that is like immature. Um, and there's not a lot of volume, granted, on the poly market stuff, and it's not super liquid, or sorry, like you probably couldn't bet this in like any super meaningful size. But at the same time, that means that it also means that, the big boys are also not going to bother trading it. So it's kind of like if you are a retail trader, this is like the kinds of things like I would be like looking for.
Those kinds of markets, there's a ton of opportunities. I was actually working with a buddy on prediction markets, building a cross exchange arbitrage approach. And it was just using two different event based markets like that. And it's because there is a lot of slack and there's a ton of opportunity there. So yeah, I think the relationships are fascinating. And I think the motives behind what people are doing is also really interesting. And it's just like some of the other conversations we're going to have about like GAX, DAX, and, these things that really rely on also having an understanding of what the counterparty may or may not be doing. So yeah, pretty curious stuff, at least in the near term. Is there anything else that you want to hit before we wrap for today?
I could just say like one thing that I have one thing that's on my radar. I just literally haven't gone around with it yet, but like what I would call like ripple trades. So for example, I did go and look at what Jets Vol was doing. Jets is the airline ETF.
Mhm.
So as all this stuff starts happening, it's like, is there something interesting going on in Jets Vol? Because, and oil prices skyrocketing and honestly, like geopolitical stress in general is not great for travel. It's not great for airlines. And um, so, it's kind of like, let me go look at the vol. And I looked at it and it's like, it looks like the vol market here is like, it's pricing it in, which is what I expected. It's too obvious, like to go look at airline vol when, oil vol is doing something. So it's a ripple trade that everybody knows about. But I think what's interesting right now is the fact that we have LLMs. Granted, everybody has LLMs, but it could be a great place for traders to get inspiration to kind of say, like, hey, you can build out a little Ripple trade project and be like, okay, um, super liquid assets are telling me that they're raising an alarm about this or that, or correlations are kind of going up. Give me, try to get me some oblique ideas, like a second level, third level ideas for like something that might be getting left behind. And I think stuff like that is like great for inspiration, can get you on the right track. And then it's also, you have to recognize like a lot of this stuff is like you're mining for gold, right? Like you're just got the metal detector out there walking on the beach. Like you don't expect to hit or you expect to hit very, very rarely on like an idea, but you have to be prospecting. Otherwise, you're not going to get any ideas. So you poke around and what's going to happen is like maybe you find a Ripple idea and then you go and you look at the option surface and be like, these options are untradeable. They're like they're way too wide or whatever. And that's what's most likely going to happen. Like if you find an opportunity, it's probably an opportunity because it wasn't liquid enough for anybody to care to update the markets properly. But you still need to like go through these exercises, and then the act of going through these exercises is probably what's going to, any trade that you do come upon that's going to be like, hey, this is a good idea, probably came from I was looking at something else and I happened to notice this. And that's uh I think understand if you don't enjoy that process, like it's actually good to know this. Like if you don't enjoy doing this, then you probably don't want to be trading. But if you do enjoy this, then this is the work to be done, and that's how you get to good ideas.
I love that. And one other thing that I would add for folks that I really like to do during periods like this is look at recent price performance. So like 5 day, 1 month, and just do a cross-sectional sorting. And you can get actually a really interesting density of stuff that indirectly starts to play. And some of them are kind of random. Some of them are in SATCOM. Some of the things that are going really interesting the last week, like CF, which is in fertilizers. So there's a lot of odds and ends that you can come across just doing like a base cross-sectional price performance analysis to give you some other inspiration like Kris is talking about. So
Eric, can I stop you there? Where do you, I like that idea. Where do you, like what tool do you use to display that?
So two different things. I have like a dashboard that I built in Python and I'll pull there. So I'll just use like a Jupyter notebook. But the other is just really basic scanning tools from places like Bar Chart, which full disclosure, I am an affiliate for them. They're not sponsoring any of this. I legitimately just like the tool. So on there, I'll literally do the same thing. I'll apply a series of different filters. And the thing I like about that one is that it just emails me. So it makes it a little easier for me to catch stuff throughout the day. But for a scan like that, I'll literally just look at stuff that's optionable, things that are either within a certain distance of like 52-week highs if I'm trying to specifically find strength or weakness, and then look for things that have had at least a certain change over the last 52 weeks. So things that are at least positive or negative if I'm going the other direction, and then have some decent OI. I think there's a balance in terms of liquidity and how much liquidity you're willing to, or illiquidity you're willing to tolerate. I actually think retail traders sometimes become way too snobbish off of like what they're willing to deem liquid enough to trade, especially if you're running smaller sizes like 1 lots, 5 lots. You can kind of get away with slightly less liquid stuff. It's never ideal. It's not specifically looking for that, but sometimes that's just where more opportunities are because there's less fucking people there. So I'll use like base liquidity filters like total OI, like 10 grand, 10,000 total OI or something. It's still like stuff that's at that level can be really illiquid, but they at least have something. And yeah, so I'll run a scan like that, and then I'll sort it by price performance on different time frames because I'm really, really into cross-sectional momentum. It's kind of like one of the bedrocks of what I do. So I like long return windows, 52 weeks, 6 month, 3 month, 1 month, 5 day, because there's also reversal factors that are really common inside those windows. And then I'll just take in this context, I'll look at some different industries and see what the bulk are, which is most people would probably expect. The bulk of what's absolutely crushing over the last week are things in like oil refining, oil is everywhere. But there's also some stuff in like aerospace, like KRMN, another just weird name that a lot of people aren't used to hearing. Stuff like that has been popping up. And that's essentially the simple way of just using, like a base platform that does scanning.
We got to get some of the outputs from that wired up to the Moon Tower API.
Oh yeah. I think that would be super cool. But
yeah, totally.
For everyone else, 2 things. If you enjoy the episode, please do not forget to rate us 5 stars on Spotify. It helps the overall beast grow. We are obviously, it's our 2nd episode, so brand new. It helps a ton. And then the second thing is, if there's anything that you're interested in us chatting about, please throw it in as a comment, reach out to the podcast email, whatever your preference is. But our goal is to make these tailored to you guys and what's relevant / top of mind for you all. Kris, absolute pleasure as always, my friend. And we will catch you all on the next episode.
All right. Have a good weekend.